Hello, everyone, and welcome. Thank you for joining us today. My name is Vinny Carries, and I'm with WCG Investments, and we are really excited to have you here for this special live webinar. Today, we'll be talking about a topic that can make a big difference in how you invest, how to use your IRAs, 401ks to invest in real estate. So we're joined by Matt Moore for CamaPlan, and he's a leader in self-directed retirement investing. Matt and his team specialize in helping investors take control of their retirement funds and put them to work in assets like real estate, including opportunities offered through WCG Investments. So at the end of the presentation, we'll open it up for questions. So with that said, let's get started. Matt, thank you for being here, and I'll turn it over to you.
Yeah, thank you very much for having me here. I really appreciate that generous introduction. And that is exactly what CamaPlan is about, is helping investors take control of their retirement capital and helping them think about it beyond just retirement, but really it being a net worth building tool. So before we get started, we have the obligatory disclosure that these slides are not investment advice or endorsements. CamaPlan doesn't provide that. We're not a fiduciary. So all information is meant to be educational, and we always encourage folks to go and seek out counsel from the appropriate individuals, attorneys, CPAs, etc., before making any kind of investment decisions. Really quickly, who is CamaPlan? I'm not going to read everything on the slide. It's there for you, but we're over 20 years old. We're a self-directed IRA administrator, acting similarly like to a custodian. We have thousands of clients across the country, all 50 states, including DC and Puerto Rico. And what's really been, critical to our success is good customer service. Our owners are Carl Fisher and Maggie Polisano. They're actually brother and sister, still very involved with the company. They are third generation real estate investors themselves, which means, and they're entrepreneurs. So they deal with a lot of financial services people, and they know what it's like to be on hold. They know what it's like to not get emails answered. So they said, when we're going to design CamaPlan, we want to make it a company that people can be easily accessed, easily reached, and that's really been fundamental from the start, and it still exists today. And in addition to that, education is a big part of teaching or about self-direction, because not a lot of people know about it, and that's why we're here today, in fact. And Carl has actually had many certifications to help him provide continuing education to CPAs, financial planners, folks like that. So what is a self-directed IRA? I mentioned that not a lot of people know what it is. And in numbers, there's about $18 trillion of IRA monies out there as of Q2 2025. But less than 5% of that is in self-directed accounts. So if you're watching this and you said, I've never heard of this, you're not alone. Or if you've heard about it, but you're not really sure about it, you're not alone. Not a lot of people know about these things. A self-directed IRA is just that. It allows the investor to self-direct their tax-advantaged capital, retirement capital, into a full scope of investments that they may not be able to invest in if they're at Fidelity or Schwab, where they're kind of just limited to the stock and bond markets. There's no legal distinction or rules or some kind of legislation that exists specifically for self-directed IRAs. Self-directed is really just an adjective, a description of how much choice an investor has when using these. And to kind of put it more eloquently, this is a quote from one of our clients, and he says it's about investing what you know and understand and can control versus using hope as your strategy. And this particular client had developed a lot of knowledge about real estate as a commercial real estate broker. And so, and he had an IRA that was in the stock market, but he had all this knowledge. And so being able to take his retirement money and put it into an asset class that he knew a lot about really helped him to have more control over growing his net worth. What are the types of self-directed plans? We like to use the analogy of taxing the seed versus taxing the harvest. So I'll start with the taxing the harvest part first, and that's what's going to be on the left side, the tax deferred kinds of accounts. So these are these are accounts that allow for monies to go in without paying taxes on them. But as you grow those returns and you take distributions when you're of retirement age, excuse me, you're going to get taxed on that depending on the tax bracket that you're in. And so the idea here is that you would be in a lower tax bracket when you're in retirement age. So the tax hit wouldn't be as great as if you were when you were, at your full income level. But for a lot of people, they don't plan to lower their tax bracket when they reach 59 and a half. The pedal's still down to the floor and they want to go, go, go. So that's why we're really partial to the other ones, the tax-free plans, where you pay taxes on the money that goes in, you tax the seed, but all of the growth that happens after that is yours, and you are able to take advantage of all of that return and not get taxed on it when you take distributions. And another kind of key part of the tax deferred accounts versus tax free accounts is, are they required minimum distributions? So required minimum distributions are calculated by the IRS based upon age and life expectancy. So when you reach 72 or 73, kind of depending on when you were born, you have to start taking money out of the account. Again, we talked about this idea of control. So you're being kind of dictated about how and when you want to take the money out. So that means that when you take the money out, you're going to be taxed on it. And depending on what you're invested in, that means you need to have the liquidity in the account. So it can be a bit of a burden, or it takes some coordination at least to figure out, okay, well, how much am I going to take out, or how much I need to at least take out this much? Do I have the money to cover for it? It just takes more work. The tax-free accounts, the Roth probably being the most popular, they don't have the required minimum distributions, and so gives you more control. You don't have to do all that juggling necessarily, and it can create a potentially more more flexible and more strategic investments landscape for you as you're figuring out what longer term investments you want to do. I talked about the idea of being able to invest in, a whole myriad of asset classes, and these are some of the more common ones we see at CamaPlan. Real estate is extremely popular with our investors, and probably among self-directed investors everywhere. Real estate really includes all kinds of property types or asset classes, and that it can even include opportunities that are overseas. So the world is really your oyster here. There's a few kind of considerations when you're investing in real estate about how it's managed, but there's a lot of opportunity and flexibility in being able to purchase real estate directly through your IRA. Another very, very powerful investment opportunity through your self-directed IRA is lending. So notes and mortgages. This can look like doing a loan directly from your IRA. It can be buying a note. It can be investing in a debt fund. Because of the nature of of debt and it being simple interest, it makes a lot of sense for a Roth IRA, for example, because that interest is just going to come into you and it will be tax free. So for investors who are doing real estate, for example, and they might have a lot of comfort and knowledge there, they have the knowledge about real estate and they say, okay, well, I know from an equity perspective, I know how to invest in real estate. And I basically understand what this borrower is going to do. So I'd be comfortable lending to them from my IRA and being able to harness this knowledge that I have about real estate, but take advantage of it in a different way through debt. The third category I'll touch on are private placements. This is structures like what WCG does. They can include investing in debt funds, in real estate equity funds, investing in venture capital, investing in companies. So there's a lot of opportunities here. This is probably the most especially in the last 5 to 8 years, this is probably the most popular structure for investments at CamaPlan, and a lot of people are investing in private placements on real estate assets or real estate funds. And then lastly, precious metals, very, very popular, especially like right now in October of 2025. There's a lot of buzz about silver specifically. So I know we have a lot of interest in that, and there's a lot of transactions going on. But again, this is not an exhaustive list. This is just some of the stuff you can do. We have a client who owns a dump truck in his IRA. So there's a lot that you can do. Now, what can you not do? Important to talk about this. Fortunately, it's a pretty limited list, but we just want to touch on it. So first, no life insurance policies, um, and no collectibles. So no baseball cards, no bottles of wine, things like that. You can invest in whiskey funds. You can invest in alcohol funds, but you just can't hold the hard assets in your IRA. The other big no-no is our prohibited transactions. And what this comes down to is your IRA is its own separate entity from you, and it has its own EIN number compared to your social security number. So your IRA cannot benefit from you, nor can you benefit personally from your IRA. What are some examples of this? You can't take a loan from your IRA from you personally, for example, or your IRA can't buy property from you personally. So those would be two examples. The other is kind of related, but has to deal with selected family members. So this is anyone of any lineal ascent or descent. So if you are the IRA holder, your grandparents, your parents, your children, your grandchildren, and then no spouses of those people. So imagine um, I buy a property in Austin, Texas. Because my daughter is going to go to UT, and my goal is that I'm going to buy a 4-bedroom house, and through my IRA, and there are going to be 3 roommates who live in 3 of those rooms, and then my daughter is going to live in the fourth bedroom. That doesn't work. Everything has to be arm's length. So I mentioned earlier about real estate being very, very popular, but it has some kind of caveats on how you manage it. That's the kind of thing that you have to be careful of. Or if you um, own a property through your IRA and you need to install a new toilet or something, you can't be the one who personally goes in and does that work. You need to pay someone to go in so that they are paid, they receive compensation. That compensation is taxed, so there's no disruption of that sort of normal tax flow. I'll pause here for a second. Are there any questions right now? I thought I saw some that might have come in, but I can keep going if you'd like.
So Daniel asked in the chat, what about art? I'm always curious if that is a collectible or investment at different times.
Great question. Yeah, so this is usually where I put in a joke if I'm doing this with my colleague Joe, but I'll use you, Tim, as the butt of the joke, so to speak. If Tim has a canvas and he draws a red stripe on it and he says, "This is worth $5 million," I'd say, "Tim, you couldn't pay me $5 to take it, right?" So that's obviously, I'm being hyperbolic here, but there's a amount of subjectivity to art that prevents it from being held in an IRA. And why this is put yourself in the mind of the IRS. These IRAs, whether they're self-directed IRAs or kind of more standard IRAs that you'd have with a brokerage like Fidelity. The whole point of these is to prepare people for retirement. So they don't want anyone blowing their savings on something that could be with value that changes so dramatically. So no art, but are there funds where you can own, shares of art that are basically securitized, that are securitized? Absolutely. And can you invest in those with your self-directed IRA? Absolutely. And the most common or most popular example of this is Masterworks. You can definitely invest in their opportunities through a self-directed IRA. So
Wonderful. Thank you, Matt.
yeah, you bet. I wanted to, it's some talking about this, talking about self-directed IRAs is great and all, but it's always good to like make the rubber hit the road. And so that's why I wanted to use an actual deal that WCG has, and I believe it's open right now. Is that correct, guys? Yep. So
It's correct. It's live.
yep. So I will actually turn it over to the WCG team, whoever wants to sort of talk about just this deal, because you know it better than I do. And if this is the basics that we're looking at on the page, but if there's, anything else you want to add or discuss, please go right ahead.
Matthias, you want to give a brief highlight of the deal?
Absolutely. Yeah. Thanks, Matt. Great introduction so far. So my name is Matthias Grunwald. I'm the operations lead at WCG Investments, one of the co-founders of WCG Investments as well. Happy to have you guys here today and looking forward to run this deal through you guys here. What we're looking at right now is a 131 lot mobile home park portfolio in Albany, Georgia. Right now, it's currently has about 84 homes that are currently in the portfolio that are sitting on lots in the portfolio, and the rest of those 47 are vacant lots, which is a major opportunity to infill new homes into the community, increasing income as well, which contributes to the distributions to the investors. The main value add item besides the infill opportunity is rent increases. The current portfolio as it stands is about $150 to $175 under market rents. So, and this in combination with the infill opportunity where we drive income up, we also drive income up with the market rents or going to market rents incrementally over the next 2 to 3 years to catch up to market rents and then basically just ride the market rent wave going forward. So those two things alone will create tremendous value on the portfolio here. And we have tremendous market knowledge in Albany, Georgia, since we have 2 communities already in the area that we're managing for the last 2.5 years. And we be getting 450 to 475 lot rents all day long. And this one sits at 295 to 305 in average. Not everybody pays the same rent in that range. So we know we can get to a higher lot rent perspective here very, very easily. And that would drive tremendous returns on that front. So as it stands right now, collections are tremendously well right now from the previous owner, which enables us to do great distributions right out of the gate because the cash flows from day one. This is pretty rare in especially multifamily and apartments. They usually have to do a tremendous value add, tremendous capex efforts to get it to cash flow. Mobile home parks cash flow really well out of the gate if you buy them right. And this one here is an exceptional example how well something cash flow from day one. We have already the financing through the bank already all set up, and we have a commitment from the bank 5-Star California for a really low rate of 6.7% interest rate on that one and a 70% LTV. We just got through due diligence and the property, all properties, there's 3 parks here in total in this portfolio, passed with flying colors. So everything is good to go. We just opened the doors to investors right now, and we're really excited to offer this to all the investors right now, since this is really one of the best deals we secured in the last couple of years, for sure.
So something that's important to mention is that this deal is open to accredited investors only. So
thanks, Vinny.
Yeah. And I think one other things to say. First of all, thanks Matt, thanks Matthias, thanks Vinny. So, we have other deals and other people have invested their IRAs and their Roth IRAs with us. And it seems to be, we hear the same thing from people. What are you getting from the stock market? 8 to 10% maybe with your Fidelity or whatever IRA you're doing. We always strive for a 2x equity multiple, meaning through cash flow and exit, we're going to double your money in 5 years. Basically, giving you an average at 20% average annual return. So, it's a lot of times a no-brainer for people to invest in stuff like our deals versus the traditional stuff that you got.
Beautiful. Um, So I appreciate all that color, really, really helpful, just for me to, as I learn about what you do and about the asset class, certainly. These numbers that are here come from the pitch deck that you shared. So based on this, we're projecting a cumulative cash flow of about 26,000 and an equity share of 45,000 or about 45,000 with a total return net of principal of about 92,000. I'll actually stop and point out something here. You can see that the bulk of the money is being made with the equity share, which is, that's that with real estate in general, that's where you tend to expect that the investments is going to really pay off for you. And what investors like about real estate specifically used in a self-directed IRA and structures like this is that the timing of the capital events really aligns well with money in an IRA. So Tim mentioned, you have money sitting with Schwab or Fidelity at, maybe it's getting 8%. The average range is 5 to 8%, and 5 to 8% isn't bad. There's a place for that, but it is just 5 to 8%. The other thing about that money is it is just sitting there. So if you are not yet 59 and a half, you can't do anything with it. So if you're thinking, okay, well, I can't touch the money and an investment is going to be illiquid in this investment, then there's a lot of alignment in terms of the timing of when you're going to really reap the benefits of this investment with when you would be able to actually access your IRA money anyway. So I just want to point out sort of the alignment of the timing of real estate and access to IRA money. Now, to take that a step further, I did a side-by-side comparison of what an investment in this deal would look like if you're using qualified funds, in this case, a Roth IRA, versus using just personal funds. And if we just look at the left-hand column, this is really just meant to show you like how this investment might work inside a Roth IRA. If you are choosing to do that and where the savings would really come in. But then if you actually compare it against the personal fund scenario, you can see that because of saving on income tax and capital gains tax, assuming a 37% tax bracket on the income tax, you're going to save, about $23,000 if you're using a Roth IRA. I will call out, I don't want to just gloss over it because I think it's important to talk about it, about that red line under the Roth IRA, unrelated business income tax, also known as UBIT. And if you are getting into self-direction for the first time, if this is, you're learning about it, you might come across this and it can sound really, really scary, and retirement dollars are precious dollars to all of us. And so you say, oh, I don't want to do anything to mess up my IRA. So I don't know about this whole UBIT thing. UBIT is, I'm just going to give you like the 30,000 foot explanation is UBIT is just the IRS acknowledging that you are using leverage in this deal. And in this case, the WCG is using leverage on this deal. There's a loan. And so this is sort of beyond the scope of what an IRA was intended to do. It's sort of no longer passive. You're using the IRA. You're already using tax advantage money, and you're taking lending dollars out of the lending pool of dollars and you're using them in this tax advantaged account. So the IRA is saying, okay, you can do this, it's fine, but we're going to tax you on it for the amount of the loan versus for not the amount of the loan, but for the ratio of what is being leveraged or how much the loan is. So if it's a 70% LTV a loan, then 70% of the profit is going to be taxed. But just like a loan gives someone more buying power if they're buying a home, for example, so does a loan in an IRA. And so if I had one of our owners, Carl Fisher, here next to me, he'd say UBIT is actually a good thing because it's the IRS basically kind of like compromising and allowing for leverage to be used, because the alternative is they say you can't use leverage at all, and then you're really like limited to what you can do in an IRA. So I wanted to call that out because I don't want to be the guy who just says, everything is puppy dogs and rainbows with IRAs. There are some things to be wary of, but if you're careful and you plan for them, you can still really get a great return if you're doing it right. All right, so we went through what self-directed IRAs are. We talked about what you can do with them and what you can't do with them, and we even had our example. So how does the process work? How do you get started with CamaPlan? We try to make it really simple. That's the goal here. So we do a lot of work on our side, but we try to make it simple for you. First step is opening an account. That takes about 15 minutes, and then you're going to need to fund your account. Now, there's 3 ways to fund the account. The first would be just a contribution, which you're limited to $7,000 annually. So that's brand new cash that you're putting into an account. If you're doing an investment like what WCG has, then you're not $7,000 is not going to be enough. So really, where most people are funding their account is either from another IRA that they have with another brokerage, or they're taking it from their like an old 401k or something like that. So that's either going to be a transfer or a rollover. And that takes about 2 weeks for the money to come from the old custodian to us. There's not too much we can do about that. It's just industry practice. And that's not a bad thing. It's just the custodians making sure the money's going to the right place. So about 2 weeks. While that's happening, we work with you to, know where do you plan to invest this money. And so during that 2 weeks, we have you fill out what's called an asset purchase directive. We also get all of the necessary investment paperwork from you, so it can be titled. The investment can be titled to your CamaPlan account. So remember, I said it's a separate entity, so your investment will be titled to CamaPlan FBO for the benefit of Matt Moore IRA. So that is the entity that will hold the investment. We take care of that. The 2 weeks, maybe it's 3 weeks, finishes, your account's funded, and in about 48 business hours, we send the money over to fund your investment. So like I said, we try to make it really, really seamless. Any kind of distributions that come from that investment go into the IRA account where they sit. And kind of in summary, like, well, what does CamaPlan do? Well, first of all, the IRS requires us to exist. They require a third party to administer these accounts. So whether that's Fidelity or CamaPlan, and a third party has to be part of the IRA administration process. We are a neutral third party. So remember that disclosure, no endorsements, no advice, anything like that. But this is also valuable to you because we're not going to sell you on anything. We're going to sell you on using a self-directed IRA, and we'll talk about the power of using a self-directed IRA, but we're not going to try to put you into a fund or sell you on Tim's art fund that he's doing something like that with his red stripes. We're just going to help you facilitate investments through your self-directed IRA, and along the way, we'll make sure that we'll do our best to make sure you're not breaking any rules and that everything's compliant. And the goal for us is to be part of your financial team So what does that mean? That means you're going to have questions and you're going to call someone from our team, and that's going to be the person you talk to basically for anytime you call CamaPlan. You're not going to get a different person, have to re-explain who you are, what you do. It's going to be the same person. And if you need us to talk to a CPA or a tax attorney, anyone like that, we're happy to have those conversations. We are in the business of hand holding, and we're happy to have as many conversations as we need to understand your situation and get you started. So that said, so some questions. I think I saw some come in.
Daniel, you want to say your question? Oh, and you're muted. It's a really good question too. I like it.
Uh, now, I've been bouncing back and forth on the self-directed IRA for a while. I actually just sent an email to CamaPlan yesterday and missed a phone call at 5 a.m. this morning from you guys, which is hilarious that this popped up.
Nice.
First thought was real estate world, everything tends to be JVs or syndications. Can I invest in either one with a self-directed?
So answer the first question, just because I'm also kind of seeing the rest of your question. So
Yep.
the structure of the deal is pretty loose. So yeah, you can invest in any of them. Certainly, definitely syndications, JVs should be no problem. Now, if you are the going back to that prohibited transactions slide, if and going into the whole self-dealing thing, if you are 50% owner, you individually are 50% owner, or you have like management responsibilities, then your IRA and your spouse's IRA or your children's IRA or your parents' IRA can't invest in that deal.
Okay, so if I'm on the GP side of a syndication, I can't be
Correct.
investing.
Correct.
Okay. And similarly, if I'm the operating partner in a JV, I can't go there. Okay, that was the big question thought there. I was talking to somebody yesterday that used his self-directed 401k to purchase a business
hmm
where I don't know what the ratio was, but basically he was 90% owner and the 401k was 10% owner.
Hmm.
Something along those
Oh,
lines. So
okay. That's a great. I'm glad you're bringing this up. Okay, so uh, if well, real estate's always easy to lean on, so I'm going to continue to lean on it. You can partner with your IRA. So if you at the purchase of the house, you're going to buy a condo, at when you purchase the condo, you can buy it with your IRA and be co-owner. Or if it's your spouse can be the co-owner with your IRA. But then everything is split down the middle in terms of that how you receive distributions for that property. So if you did 50-50 with your spouse and your IRA, then 50% of the rent would go to her, and then 50% of the rent would go to your IRA. When you pay for any kind of repairs, 50% has to be paid by her, 50% has to be paid by your IRA. So that it is possible, and maybe that's kind of sounds like it might be what your person did, your
it
friend.
could be. I'm not going to pretend to know.
Yeah,
It just I'm the type that wants to know everything before jumping in,
yeah.
and
But I am
and
glad you brought that up because, again, just going back to the psychology of all of this, you're like, hey, I don't want to mess anything up. But the partnering thing is totally allowed, and it does. You can, my coworker, who I said I normally make the joke with, Joe, he invests with his IRA and his wife very, very often. And that's how for them they want to get into like bigger deals, but maybe the investment minimum is too much for them individually. So they work it out with the sponsor where they say, hey, can we come into this deal? It's, we're a couple, but we're gonna put all our chips in together. through this structure of it's his IRA and it's her personal money, and they meet the threshold that way. So partnering is absolutely allowed, and it can be a really powerful tool as you're wanting to invest larger amounts, but you may not have the proceeds either yourself in liquid cash, or altogether you don't have them, so you want to partner with your dad or something like that.
Any other questions?
Yeah, I got one. For people that don't have a good company that they're with that allows self-directed, or they're having difficulty, how do you have that conversation with them about moving to another provider? That seems like a bigger deal than just the investment. You're talking about somebody's retirement account and maybe shifting it over to a whole other platform so they can proceed. What's some of the challenges you run into, and how do you have that conversation?
Yeah. So you're at a company, you have a 401k with them, and it's pretty limited. Or I'm not saying you do, but this, that's the scenario we're talking about, right? They're not very, and they want more choice. I'll be just completely honest with you. If you're not over 59 and a half and you're still with that, and you're with that employer, the options are more limited for you in terms of what you can do with that money, because the plan has probably been written as such where the agreement with the existing custodian, they want to keep that money in house. That's not always the case, though. There are plans that allow for taking like a vested portion out, or a percentage of the vested portion out, or just a percentage of the balance out, and putting it into a self-directed plan. Now, we are pretty good at we look at these plans. So clients will send us plans and say, hey, is there anything that allows me to self-direct in my existing company's plan? And you can go ask your HR person if you can do it. Your HR person may have never heard of a self-directed IRA, so caveat there. But if they don't know, or you want a second set of eyes, we're more than happy to look at a plan with you and see if there's any kind of like carve out or anything like that that would allow for having like a self-directed component in your existing plan. There have been situations where we've had clients who they determine there's no allowance for that, but they've been able to successfully approach their employer and ask them to amend the plan so that they can basically have a self-directed portion of their existing plan. But to your point, that is that's a lot. That's like an organizational change potentially. So does it happen often? It does not happen often. These plans are written the way they are for a reason, but there's more popularity with alternative assets. There's more popularity with self-directed IRAs. So we're seeing more options show up within plans and a little bit more flexibility. Probably the most like hopeful indication to this point is the executive order that Trump signed in August, I believe, and it said that retirement plans need to allow for their plan participants, so people who have the 401ks, to be able to invest in private deals and like in alternative assets. That's an executive order. Like actually putting that into practice, we're many years away from that being like a scalable thing. But to have that kind of activity happen at that level for alternative assets is pretty promising.
Good stuff.
But short term, like practical first step is happy to look at your plan documents for you and just see what the opportunity is there for you.
Any other questions? So Matt, if somebody's watching this recording
Mm-hmm.
and they think, hey, I want to use some of my IRA funds to invest in that Albany deal because it looks really good. And I want to use CamaPlan services. What is the next step? How do they get a hold of you?
You're so smart. So this is what they can do. They can email us, they can call us. Just those are the email and phone number are our main lines. But our client team will know who WCG is. Just mention this webinar. You can use the QR code and you'll come to WCG's CamaPlan landing page, and this will have the same contact information. It'll also have a form you can fill out for someone to call you, or you can actually just get started and open an account from that landing page. But this is the best place to start. We are committed to, talking to people through what like I said, what their situation is. Does their 401k allow for it? Does their 403b allow for it? Can they move money over? And we'll go through all of those scenarios with them. But we find it's best to get started with a phone call, talk through your situation, and go from there.
That's awesome. Good stuff. This was really informative. So Matt, I want to thank you so much for sharing your expertise and walking us through how investors can use their IRAs and 401ks to participate in real estate deals. And thank you everyone who joined us today. We appreciate you taking the time to learn with us. We'll be sharing the recording of today's session in case you would like to review it or share it with your friends. So on behalf of WCG Investments and our team, thanks again for joining us, and we look forward to seeing you on the next webinar.